When it comes to active versus passive investing, it is interesting that one of the most successful active investment managers, Warren Buffett, when he is asked for investment advice, he says just invest in the low-cost passive index fund that tracks the S&P 500. Because when all is said and done in terms of the fees and all the buying and selling, he makes the argument that on average, on the aggregate, you will be better off investing in a passive fund rather than trying to pick the active funds that will outperform. So in his 2016 letter, he talks about a bet that he made against the active investment industry effectively. He said that, and you can read this in your own time, every year up until last year he provides an annual letter. They're full of nuggets of wisdom. But here he talks about a bet he made against active funds. So he said, now to my bet and its history. In Berkshire's 2005 annual report, I argued that active management by professionals in aggregate would over a period of years underperform the returns achieved by rank amateurs who simply sat still. I explained that the massive fees levied by a variety of helpers would leave their clients, again in aggregate, worse off than if the amateurs simply invested in an unmanaged low-cost index fund. Subsequently, I publicly offered to wager $500,000 that no investment pro could select a set of at least 5 hedge funds, widely popular and high-fee investing vehicles that would, over an extended period, match the performance of unmanaged S&P 500 index funds charging only token fees. I suggested a 10-year bet and named the low-cost Vanguard S&P 500 fund as my contender. I then sat back and waited expectantly for a parade of fund managers who could include their own fund as one of the 5 to come forth and defend their occupation. After all, these managers urged others to bet billions on their abilities. Why should they fear putting a little of their own money on the line? What followed was the sound of silence. Though there are thousands of professional investment managers who have amassed staggering fortunes by touting their stock selecting prowess, only one man, Ted Sides, stepped up to my challenge. Ted was a co-manager of Protege Partners, an asset manager that had raised money from limited partners to form a fund of funds. In other words, a fund that invests in multiple hedge funds. I hadn't known Ted before I wagered, but I like him and I admire his willingness to put his money where his mouth was. He has been both straightforward with me and meticulous in supplying all the data that both he and I have needed to monitor the bet. For Protege Partners' side of our 10-year bet, Ted picked 5 funds of funds whose results were to be averaged and compared against my Vanguard S&P index fund. The 5 he selected had invested their money in more than 100 hedge funds, which meant that the overall performance of the fund of funds would not be distorted by the good or poor results of a single manager. Each fund of funds, of course, operated with a layer of fees that sat above the fees charged by the hedge funds in which it had invested. In this doubling up arrangement, the larger fees were levied by the underlying hedge funds. Each of the fund of funds imposed an additional fee for its presumed skills in selecting hedge fund managers. Here are the results for the first 9 years of the bet, figures leaving no doubt that Girls Inc. of Omaha, the charitable beneficiary I designated to get any bet winnings I earned, will be the organization eagerly opening the mail next January. So here's the data from 2008 to 2016. You can see that he provides the returns on a calendar year basis for fund of funds A, B, C, D and E, and as well as that the S&P index fund. And you can see in terms of the first year starting off to invest in, 2008 is arguably one of the worst years that they could pick in the history of stock market returns. The S&P 500 index fund was down 37%. Nevertheless, over the period, the 10-year period, here we're just looking at 9 years, the fund of funds A, B, C and D and E all underperformed the S&P 500 index fund. A was 8.7% in terms of the gain to date, B 28.3, C 62.8, D 2.9, E 7.5, and then 85.4% for the S&P index fund. That meant that over that period, the compound annual increase for the index fund is 7.1%, which is a return that could easily prove typical for the stock market over time, Warren Buffett says. Remember, so that's what I was saying about over time. People talk about 6, 7%, maybe 8% in equity markets for the long-term investor that is willing to deal with the types of volatility and drawdowns that you see. And he says that's an important fact. A particularly weak 9 years for the market over the lifetime of this bet would have probably helped the relative performance of the hedge funds because many hold large short positions. Conversely, 9 years of exceptional high returns from stocks would have provided a tailwind for index funds. So he's kind of saying we operated in what I would call a neutral environment, he says. So in it, the 5 funds of funds delivered through 2016 an average of only 2.2% compounded annually. That means 1 million invested in those funds would have gained 220,000. Meanwhile, the index fund would have gained 854,000. So, we're talking about 4 times what you would have gained in the fund of funds, the average of the fund of funds. So Warren Buffett was effectively using this as an example to show that when you factor in high fees, the nature of hedge funds, the layered fees when you're looking at fund of funds, that you're actually better off just being in a low cost passive index fund that will over time outperform these types of funds of funds. And when you look at the final numbers in terms of the bet, because the following year he published a 2017 letter, and I've pulled that up here, he says that the final gain for the S&P index fund was an average annual gain of 8.5%, whereas when you looked at the funds of funds, A delivered 2%, B 3.6, C 6.5, D 0.3 and 2.4 on the fund of funds E. So over the life of that bet, the index fund just significantly outperformed the fund of funds alternative, and it came with much less effort and maintenance. You just bought the index fund and that was that. Whereas the fund of funds, that manager was making changes in terms of picking underlying active hedge fund managers to try and outperform. They couldn't do it. And hedge funds are notoriously sophisticated, and so he went up against, I suppose, the most active form of investment management. Now, the alternative to that, some people would say, you know what, that's great, but I wasn't concerned about investing in active hedge funds. I might be looking at an active small cap fund, and I would like the opportunity to invest in a manager that might outperform. And if you feel like that makes sense for you, then go ahead. But what Warren Buffett is putting forward here in terms of his case is that over time, you're just better off owning the index. And as it turned out, the bet really showed that he was proved right. Now, when you read through this letter, you can get into more detail on why he believes the case for passive management is so strong. A lot of it revolves around fees. And he also gives credit in this particular letter to Jack Bogle. Remember, I mentioned him as the founder of Vanguard. So he says in it, if a statue is ever erected to honor the person who has done the most for American investors, the hands-down choice should be Jack Bogle. For decades, Jack has urged investors to invest in ultra-low-cost index funds. In his crusade, he amassed only a tiny percentage of the wealth that has typically flowed to managers who have promised their investors large rewards while delivering them nothing, or as in our bet, less than nothing of added value. In his early years, Jack was frequently mocked by the investment management industry. Today, however, he has the satisfaction of knowing that he helped millions of investors realize far better returns on their savings than they otherwise would have earned. He is a hero to them and to me. And then he says underneath that, over the years, I've often been asked for investment advice, and in the process of answering, I've learned a good deal about human behavior. My regular recommendation has been a low-cost S&P 500 index fund. To their credit, my friends who possess only modest means have usually followed my suggestion. So when it comes to active or passive management, take that on board and you make your decision, but at least be informed in terms of the issue of investing in active funds and the fact that over the long term, very few active fund managers will be able to outperform the low-cost passive index funds that are available to investors.